Imagine some of the world's most powerful brands, with multi-billion-dollar valuations, millions of loyal customers and footprints on every continent, suddenly forced to confront a brutal reality: what happens when the music stops? When a recession hits, wallets tighten and confidence evaporates overnight. Even titans can falter. Too much debt, razor-thin margins, and an over-reliance on discretionary spending can turn yesterday's darlings into tomorrow's cautionary tales. Below, we count down 10 household names that may not survive the next economic storm. Number 10. United Airlines. Once synonymous with global connectivity, United Airlines faces a potential downturn in leisure and business travel alike. In Q1 2024, fuel costs jumped 10%, and lingering pandemic debts still hover large. Should consumers cut vacations or conferences, half-empty flights could turn today's losses into tomorrow's insolvency. Number 9. DuPont de Nemours Incorporated, the century-old innovator behind Teflon and Kevlar, is struggling to stay ahead. Its share price has fallen over 25% in the past year, and it has missed Wall Street's earnings targets 4 times consecutively. Dependent on construction, automotive and electronics demand, DuPont risks steep margin compression if industrial activity stalls again. Number 8. General Electric Company, once valued at over $600 billion, GE has slimmed down to a market cap near $170 billion through divestitures and restructuring. Now organized into aviation, healthcare, and energy divisions, it remains vulnerable. Fewer flights mean fewer jet engine contracts, healthcare budget constraints delay equipment purchases, and energy projects get shelved when governments tighten their belts. With roughly $40 billion in long-term liabilities still lingering, a credit squeeze could force more asset sales. Number 7. Big Lots Incorporated. Discount retailers often fare better in recessions, but Big Lots tells a different story. In 2023 it posted a $200 million net loss, and same-store sales fell 7.3%. Rising inventory costs, higher wages, and shrinking foot traffic have left its 1,400 stores on shaky ground. If budget-strapped shoppers cut back further, closures may soon follow. Number 6. Lyft Incorporated. Lyft's fast-growing ride-hailing service has never turned a profit. In 2023 it lost $1.6 billion, despite millions of monthly rides. Driver shortages, intense competition, including from Uber, and razor-thin margins hurt its economics, and in a downturn, consumers either drive themselves or stay home. With market share slipping below 30%, Lyft's growth-at-all-costs model may not survive a prolonged slump. Number 5. Uber Technologies Incorporated. Uber's diversified platform, from ride-hailing to eats to freight, still hasn't delivered reliable profits. Q3 2023 saw a $1.2 billion loss amid weak mobility demand and costly international ventures. And with over $9 billion in long-term debt, tightening credit markets could amplify losses if consumers rein in spending and partners demand better terms. Number 4. Ford Motor Company. A century-old icon of American industry, Ford carries more than $122 billion in total liabilities. A deeper recession would hammer big-ticket sales of trucks and SUVs. While its $4.7 billion EV division loss in 2023 highlights the hidden costs of electrification. Ongoing supply chain bottlenecks and volatile raw material prices, key inputs for batteries, could compound cash squeezes when financing costs rise. Number 3. Tesla Incorporated. The EV pioneer has cut vehicle prices by over 20% in 2024 to maintain demand, but that strategy has slashed margins. Operating income plunged nearly 50% year-over-year. Overcrowded by legacy automakers and new entrants, Tesla's growth depends on premium pricing and volume. In a recession, buyers defer $40,000 purchases and financing dries up. Meanwhile, ambitious gigafactory plans and R&D investments drain cash if borrowing costs spike. Number 2. J.C. Penney Company Incorporated. Once an anchor of the American mall, J.C. Penney now runs fewer than 650 stores, down from 1,000, and its 2020 bankruptcy cast a long shadow. dependent on impulse buys and middle-income foot traffic. The retailer struggles against online competitors like Amazon and Walmart. Its limp e-commerce platform, thin margins, and declining mall visits, off 25% since 2019, leave it perilously exposed to any further consumer pullback. Number 1. Sunrun Incorporated, the residential solar leader, once valued at over $20 billion, now trades below $3 billion. With installation costs of $15,000 to $25,000 per home, most buyers rely on long-term financing. Rising interest rates and tighter credit can derail deals overnight. Sunrun's $700 million plus annual losses and decades-long lease contracts amplify risk. Customer defaults or relocations translate directly into write-offs, especially dangerous when housing markets wobble. History teaches us no company is too big to fail, particularly when debt mounts, margins disappear and consumers hit pause on big purchases. Keep an eye on these 10 firms. Your portfolio, or your next purchase, may depend on whether they can weather the coming storm.